gold is shining brighter than ever. Like we told you yesterday, prices have crossed $5,000 an ounce for the first time because of global tensions and economic uncertainty. And while that may worry some, for others, the situation has turned into a literal gold mine of opportunity. In South Africa, one of the countries most closely linked to gold, a gold boom is bringing abandoned mining sites back to life.
The South African rand gained on Tuesday as gold prices soared to a new all-time high of $3,018.66. The rally, driven by investor concerns over U.S. trade tensions, boosted local market confidence. With South Africa being a key gold producer, analysts expect miners to increase output. Meanwhile, in earlier trading today, the rand was up 0.4% to 18.02 to the dollar, while the Johannesburg Stock Exchange
has surged to an all-time record high of over $5,000 an ounce. The rand has also strengthened to below 16 rand to the dollar for the first time in almost 4 years.
The South African rand saw gains in early trading on Friday, driven by positive signs in the domestic economy and a weaker dollar in global markets. The dollar slipped by approximately 0.1% against various currencies following an unexpected drop in U.S. manufacturing, sparking concern of an economic slowdown. Concurrently, the JSE experienced a decline on Friday morning, mirroring global market weakness amid growing apprehension of a U.S. recession.
Today, we look at a major shift in the global economic picture as South Africa's gold sector surges and the rand shows fresh strength, while the United States faces slower momentum in key areas. The story begins with hard numbers and visible trends. Gold production and gold-linked earnings in South Africa have risen in recent months, driven by higher global demand, tighter supply, and renewed investor interest in physical assets. At the same time, the rand has gained ground against major currencies, reflecting stronger export inflows and improved confidence in certain parts of the economy. Gold prices have remained elevated as global markets deal with uncertainty around inflation, debt levels, and long-term growth. Investors have been looking for stores of value that feel stable when paper assets look risky. South Africa, as one of the world's most important gold producers, has been a direct beneficiary of this shift. Mining companies have reported higher revenues, export receipts have increased, and foreign currency inflows linked to gold sales have supported the balance of payments. These are measurable outcomes that show up in trade data, company earnings, and currency markets. The rand's recent performance is closely tied to these developments. A stronger flow of dollars and other hard currencies into South Africa helps support the local currency. When exporters earn more, they convert part of those earnings into rand, increasing demand for the currency. This effect has been visible in trading activity, where the rand has held firmer levels even as many emerging market currencies have struggled. Analysts warn that currency strength can be fragile, but they also note that commodity-backed gains tend to be more durable than short-term speculative moves. In contrast, the United States has faced a different set of pressures. Gold production there plays a much smaller role in the overall economy, and the country is more exposed to shifts in financial markets, debt servicing costs, and consumer demand. Recent data points show uneven growth across sectors, with manufacturing and exports facing challenges from higher borrowing costs and global competition. While the U.S. dollar remains strong overall, its dominance does not shield the economy from slower growth in certain industries. Looking strictly at the facts, South Africa's gold exports have grown faster than several other major export categories. Mining activity has supported jobs directly and indirectly, from logistics to equipment maintenance. Government revenues linked to mining royalties and corporate taxes have also seen an uptick, helping public finances. At a time when fiscal pressure remains high, these developments are not guarantees of long-term stability, but they represent a clear short-term boost. At the same time, the rand's strength has helped reduce the cost of imports, especially fuel and machinery. A stronger currency can ease inflation by making foreign goods cheaper. Recent inflation readings have shown some moderation, partly linked to currency effects and lower import costs. Analysts warn, however, that if the rand strengthens too quickly, it could hurt other exporters who rely on competitive pricing. This balance between currency strength and export competitiveness is a familiar challenge for resource-based economies. The gold boom also reflects broader global dynamics. Central banks in various countries have increased their gold reserves, seeking diversification away from traditional assets. This steady institutional demand adds a layer of support to prices that is less sensitive to short-term market swings. For South Africa, this creates a more stable demand environment than in past cycles when gold prices were driven mainly by speculative trading. The United States, meanwhile, has been navigating high interest rates designed to control inflation. These rates make borrowing more expensive for businesses and consumers, slowing investment and spending. While this policy aims to stabilize prices, it also affects growth. In such an environment, countries that benefit from commodity exports can appear to be moving faster, even if their long-term challenges remain unresolved. This contrast has led some observers to say that South Africa is, at least for now, leaving America behind in this specific area of economic performance. It is important to be precise about what that means. It does not suggest overall economic dominance or a permanent shift in global power. It refers to a narrow but significant window where gold revenues and currency strength have given South Africa an edge in growth momentum compared to certain U.S. indicators. There are also risks embedded in the current situation. Mining is capital-intensive and sensitive to operational disruptions. Power supply issues, labor disputes, and infrastructure constraints can quickly reduce output. Analysts warn that without continued investment and stable operations, the benefits of high gold prices may not fully translate into long-term development. Environmental concerns and regulatory uncertainty also remain part of the conversation. For the rand, global sentiment still matters. If investors suddenly move away from riskier assets, emerging market currencies can weaken rapidly, regardless of domestic fundamentals. This means the current strength should be viewed as conditional, supported by favorable external factors that could change. Even so, the recent performance highlights how commodity cycles can reshape economic narratives. In the United States, policymakers continue to focus on balancing inflation control with growth support. Slower momentum in some sectors does not imply decline, but it does show how interconnected global markets have become. When capital flows toward commodities and away from financial assets, countries positioned to supply those commodities can gain temporary advantages. This could mean that South Africa has an opportunity to leverage its current position to strengthen its economic base. Higher revenues could be used to invest in infrastructure, energy stability, and skills development. If managed carefully, the gold boom could support diversification rather than deepen dependence on a single sector. History shows that resource windfalls can be either a blessing or a mischance depending on policy choices and governance. For ordinary people, the effects are mixed. A stronger rand can lower the cost of imported goods, easing pressure on household budgets. At the same time, mining jobs are often concentrated in specific regions, and benefits may not be evenly distributed. Analysts warn that without inclusive growth strategies, public frustration can rise even during periods of strong export performance. Internationally, this moment also feeds into debates about the future of money and value. Gold's renewed prominence suggests lingering doubts about long-term financial stability in a world of high debt and geopolitical tension. South Africa's role in supplying this asset gives it relevance beyond its size, at least in commodity markets. As we watch these trends unfold, it is clear that the story is not about one country winning and another losing in absolute terms. It is about timing, structure, and exposure to global forces. Right now, gold is shining, and South Africa is positioned to benefit. The United States is navigating a different phase of the cycle with its own strengths and constraints. The key question is how long this window will stay open and what choices will be made while it lasts. Will the current gains translate into lasting resilience, or will they fade as markets shift again? And as viewers watching these global changes, how do you think resource-driven growth should be managed to create real, long-term benefits for people on the ground? The wider implications become clearer when we look beyond daily market movements and focus on structure, strategy, and long-term positioning. South Africa's current advantage is not only about gold prices or a stronger rand in isolation. It is also about how global capital is reacting to uncertainty and how different economies respond. When investors seek safety rather than rapid expansion, gold has always played a special role in times like these. When confidence in paper assets weakens, attention often turns to physical resources with long histories as stores of value. South Africa's mining sector, despite its age, still holds deep relevance in this environment. Production costs or quality and established trade relationships give the country a position that newer producers often struggle to match. Analysts warn that this advantage can narrow if costs rise too quickly or if operational challenges are not addressed, but for now the fundamentals remain supportive. The strengthening of the rand also sends signals to international markets. Currency traders closely watch commodity-linked currencies because they often reflect real economic flows rather than pure speculation. When the rand holds firm, it suggests that export revenues are not only strong but consistent. This can attract longer-term investment, especially from funds seeking exposure to real assets rather than short-term financial instruments. This could mean a broader base of capital entering the economy beyond just mining. In comparison, the United States continues to rely heavily on financial services, technology, and consumer-driven growth. These sectors are powerful, but they are also sensitive to interest rates and debt levels. As borrowing costs stay high, investment decisions become more cautious. Companies delay expansion, consumers spend less on credit, and growth slows in specific areas. This does not erase the country's strengths, but it changes the pace and direction of momentum. What stands out in this contrast is how different economic models respond to the same global pressures. When money is cheap, financial and technology-driven systems often move faster. When money is tight and uncertainty rises, resource-backed economies can appear more stable. This cycle has played out many times before, but each time, it raises fresh questions about balance and sustainability. For South Africa, the gold boom also intersects with social and economic realities at home. Mining communities are often among the most affected by changes in global prices. When revenues rise, there is potential for better wages, improved safety standards, and stronger local economies. However, analysts warn that without clear frameworks, gains can be uneven. If profits flow mainly to balance sheets without translating into broader development, public trust can weaken. Energy remains a critical factor in this equation. Mining is energy-intensive, and stable power supply is essential for maintaining output. Recent improvements and contingency measures have helped reduce disruptions, supporting production levels. Still, long-term stability depends on deeper investment and structural reform. This could mean expanding alternative energy sources, modernizing infrastructure, and improving efficiency across the grid. From a trade perspective, higher gold exports strengthen South Africa's position in global negotiations. Countries with strong export currencies often have more leverage in trade discussions, as they bring essential resources to the table. This could mean better terms, diversified partnerships, and reduced vulnerability to single market shocks. Over time, this kind of leverage can reshape economic relationships in subtle but meaningful ways. Meanwhile, the United States faces its own strategic choices. Maintaining global influence while managing domestic pressures is a complex task. High interest rates may control inflation, but they also test resilience across sectors. Manufacturing competitiveness, export growth, and workforce participation all feel the impact. In this environment, the contrast with commodity-driven gains elsewhere becomes more noticeable, even if temporary. This moment also highlights a deeper issue about value creation. Gold does not rely on rapid innovation cycles or consumer trends. Its value is rooted in scarcity, history, and trust. Financial assets, on the other hand, depend heavily on confidence in systems and institutions. When that confidence wavers, even slightly, the shift toward physical assets can be swift. South Africa's exposure to this dynamic places it at an interesting crossroads. This could mean an opportunity to rethink development priorities. Instead of viewing gold purely as an export, there is potential to expand local processing, skills training, and downstream industries. Adding value within the country could reduce reliance on raw exports and create more resilient economic structures. Analysts warn that this requires careful planning, clear regulations, and long-term commitment, but the payoff could be significant. For the rand, sustained strength would depend on more than gold alone. Diversifying exports, improving productivity, and maintaining fiscal discipline all play roles. Currency markets are forward-looking, and confidence can shift quickly if fundamentals weaken. Still, the current trend offers breathing space, allowing policymakers and businesses to plan with slightly more certainty than before. On the global stage, this situation feeds into broader discussions about multipolar economic influence. No single country controls all flows of value. Instead, different regions rise and fall with cycles, resources, and decisions. South Africa's current position does not signal a permanent realignment, but it does remind observers that economic relevance can shift in unexpected ways. For ordinary citizens watching these developments, the key concern remains practical impact. Will jobs become more secure? Will prices stabilize? Will public services improve? A stronger currency and higher export revenues create potential, but outcomes depend on choices made now. analysts warn that moments like this often pass quickly if not used wisely. In the United States, households face different questions. High borrowing costs affect mortgages, credit, and business loans. While employment remains relatively stable, uncertainty about future growth shapes decisions. This contrast with resource-driven momentum elsewhere can influence global investment flows, at least in the short term. Looking ahead, much depends on how long global demand for gold stays elevated. If inflation fears ease and confidence in financial markets returns, attention may shift again. South Africa's challenge is to ensure that gains made during this period leave lasting foundations. Infrastructure, education, and diversification are often cited as the pillars that turn temporary booms into long-term progress. At the same time, the United States continues to adapt its strategy, balancing domestic needs with global responsibilities. Slower momentum in one phase does not define the future, just as rapid gains elsewhere do not guarantee permanence. Economic cycles are rarely linear, and today's advantage can become tomorrow's test. As this story develops, it invites a broader reflection on how nations measure success. Is it short-term currency strength, export revenue, or long-term stability and shared prosperity? South Africa's gold boom and stronger rand offer a clear case study in how global forces can elevate one economy while another navigates restraint. So as we watch these trends unfold, the question remains open. Should countries focus on maximizing gains during favorable cycles, or should they prioritize building systems that soften the impact when those cycles inevitably turn?